All right, buckle up, everybody, because today we're going deep. We're diving into the investment strategies of, well, someone claiming to have made over $1 million just last year. And they did it by riding the wild waves of this crazy market we've been seeing, focusing on 6 specific stocks. Not afraid of a little volatility, that's for sure. So, are you ready to see how they pulled it off? We're going to be looking at Palantir, Tesla, Nvidia, Marathon Digital, Robinhood, and an ETF called SCG.
That's really interesting. The source actually embraces the volatility. They say that smart money moves before the masses. It's a pretty bold statement, but when you look at their portfolio, well, it kind of reflects that belief.
Yeah, and they don't waste any time. They jump right into painting this picture of the market,
Yeah.
like a rough sea, especially when it comes to AI stocks. Their argument is if you wait for the perfect moment, well, you might miss the boat completely.
Yeah, and that kind of thinking has some historical backing. Think about the dot-com bubble. The people who really saw the potential of the internet early on, even with all the skepticism, well, they were often the ones who came out on top.
It's all about recognizing the potential, right? Like
Yep.
what our source sees in Palantir. Even after, get this, a 28% drop in its stock price in just 2 weeks. Most people would be heading for the exits, but this source is doubling down.
It's a contrarian move for sure. Their logic is all about how Palantir is in this unique spot, making AI actually work for businesses. It's not just about, building the tech, it's about actually putting it into practice, solving real-world problems. They believe that's what sets them apart in a market where everyone's shouting about AI.
So they're like I don't know, like having a powerful engine is one thing, but knowing how to drive the car is another. So is Palantir like the driving instructor of the AI world?
Exactly. They provide the tools and the know-how to actually navigate all the complexities of using AI. And that leads to real results. I mean, their enterprise customer base, it's growing at 33% year over year. And some sectors are seeing revenue growth as high as 70%. That tells you it's a product businesses actually rely on, and that's where that recurring revenue comes in, the gold standard.
So it's more than just hype. There are real numbers to back up their excitement. But still, 28% is a pretty steep drop. What's their plan for dealing with that?
They've got this three-pronged approach. Holding on to the shares they've already got long-term, buying even more stock, and then selling covered call options. Basically, they're betting big on Palantir's growth in the future, while also using options to make some income during this dip. It's a bold move. You got to have a lot of faith in the company to do that.
It definitely is. I mean, I see how it could pay off if Palantir keeps growing.
Yeah.
But what are the risks here? Are they putting all their eggs in one basket?
Well, for one thing, the market doesn't always play fair. Even if a company has strong fundamentals, there are things outside their control, like regulations changing or the competition getting fiercer. What do you think? You've been following Palantir. Do you share their optimism?
I get their reasoning, but I'm a little more hesitant, I guess. A big chunk of their business relies on government contracts, and that makes me a bit nervous, depending on one sector like that.
Yeah, I see what you mean. Relying too heavily on one sector can be risky, especially with a company like Palantir operating in, a politically sensitive space. It's something to watch for sure.
All right, well, let's move on to another big player in the tech world, Tesla. They've been the leader in electric vehicles for a while now, but is their time at the top coming to an end? Our source seems to think so.
Yeah, they are concerned about a few things, like how demand for electric vehicles in general seems to be slowing down, how Tesla's profit margins are shrinking, and of course, more and more competitors are jumping into the EV market.
And then there's the big question, right? Elon Musk and all his other projects. Could that be a factor in how Tesla's performing, with his attention being split so many ways?
Yeah, the source definitely brings that up. They're worried that Musk having his hands in so many different companies could be affecting things. They point to the fact that Tesla's stock price has dropped 40% from its peak, and the revenue growth predictions aren't great, just 2.6%. It seems like even someone as visionary as Elon Musk can only do so much.
It's crazy to think that just a few years ago, Tesla seemed unstoppable. It shows you how fast things can change in tech, right? Even the biggest companies aren't safe from market forces.
Absolutely. Tesla's situation is a big reminder that what worked in the past doesn't guarantee success in the future. Even the most innovative companies need to keep adapting if they want to stay on top.
Speaking of adapting, let's talk about Nvidia. They've been doing really well, exceeding expectations with a 78% year-over-year revenue increase. But here's the weird part. Their stock still dropped 8% after they released their earnings report. What's the deal with that?
It seems like the market was expecting Nvidia to keep up that crazy growth. And even a small dip below those expectations can spook investors. You know how these hype cycles go? Expectations get so high that even good news isn't enough.
Right, but is there something else going on here? Could it be more than just the market overreacting?
Well, the source points to two big threats they see coming for Nvidia.
Okay, hit me with them. I'm curious now.
All right, so first, they're worried about those 25% tariffs on some goods coming in from China. That could seriously cut into Nvidia's profits. And second, they see the competition heating up, with big tech companies like Google, Amazon, Microsoft, and AMD all wanting a piece of the AI pie.
So it's not just about doing better than expected. It's about navigating all this complex stuff happening on a global scale and with
Right.
competitors, right? So what's their plan for dealing with all the ups and downs with Nvidia?
They're holding on to their shares for the long run because they still believe Nvidia is the leader in AI. But they're also using this strategy called wheeling to make some money while they ride out the volatility.
Wheeling. That sounds interesting. What
Yeah.
exactly does that involve?
It's kind of a, well, it's an options trading strategy, a little advanced. Basically, it's like renting out your Nvidia shares with a chance you might have to buy more at a lower price. If the price goes up, you profit from the rent. If it drops, you could end up with more shares at a discount.
Okay, I think I get it. Sounds like you could soften the blow if the market dips, but you probably need to really know how options work to do that, right?
Definitely not for beginners. It's a calculated risk that could work out well, but you got to know what you're doing.
All right, let's switch gears again and talk about a company that's connected to, well, the sometimes wild world of Bitcoin, Marathon Digital. This one's been on a roller coaster, dropping 47% in the last 3 months and 54% over the last year. So, with all that going on, is this even a company worth thinking about?
It's definitely high risk, but also high reward. The source believes there's more to the story than just those recent price drops. They highlight how Marathon's core business is actually pretty strong, showing some impressive gains. Like their revenue jumped 69% to $656 million year over year. Their net income shot up 100% to $541 million. And their Bitcoin reserves, well, those went through the roof, increasing by a massive 197%.
So even with all the craziness in the crypto world, they're showing some solid growth. What's the source doing with this digital roller coaster? Are they just holding on tight, or do they have a strategy?
Well, they're doing a bit of both, actually. They're holding some shares, but they're also selling options, specifically covered calls. It's a way to potentially make money from all that volatility that comes with the crypto market.
So they're taking advantage of the swings, trying to make them work for them. But wouldn't that be super risky for someone who doesn't really know much about crypto or options trading?
You're absolutely right. It takes a lot of experience and a high tolerance for risk, not something to jump into without doing your homework.
Got it. Okay, let's move on to a company a lot of people think of as, for beginner investors, Robinhood. But our source wants us to rethink that. They say it's actually an undervalued giant with huge potential.
They make a pretty strong case, pointing to all the impressive numbers Robinhood is putting up. Revenue's up 115% year over year, reaching $1.01 billion. Net income went crazy, up by a mind-blowing 1,000% to $916 million. And net deposits climbed a solid 42% to $16.1 billion. I mean, those numbers tell you they're growing fast, and they're becoming way more than just a platform for beginners.
Yeah, those are some hard to ignore numbers. But what's driving all this growth? Is it sustainable or is it just a temporary thing?
Well, the source believes this is just the start for Robinhood. They think the company could double in value in the next 12 to 24 months, mainly because of their expansion into the UK and Asia. They see this as Robinhood aiming to be a global force in finance, not just, a player in the US market.
So they're not just aiming for the casual investor anymore. They want to be a big deal globally. How are they planning on taking advantage of all this potential?
Because they're so optimistic, they're using a strategy of selling put options to bring in some income while they wait for the price to go up. This way, they could potentially profit even if the stock doesn't move much in the short term.
That's interesting. But is it realistic to think Robinhood will double in value? The financial world is pretty competitive, and breaking into new countries can be tough.
Good point. Robinhood will be going up against established companies in both the UK and Asia, and dealing with all those different regulations won't be easy. It's still uncertain whether they can keep growing at this pace long term. What do you think? You've been following fintech for a while. Do you agree with their optimism?
I think Robinhood's definitely worth keeping an eye on, but I'm not sure about them doubling in value. Their international expansion could be a game changer, but it also has a lot of potential pitfalls. It's a situation to watch closely.
I agree. There's a lot of potential, but also a lot we don't know yet. It'll be interesting to see how it all plays out.
All right, let's switch gears to a different kind of investment, an ETF called SCG. This is a bit different from all the individual stocks we've been talking about. This is more about investing in a bunch of top tech companies at once.
Right. ETFs, or exchange-traded funds, are basically like baskets of stocks. You can invest in a whole group of companies with just one purchase. And SCG specifically holds some of the biggest names in tech, like Apple, Microsoft, Nvidia, Amazon.
So it's like a one-stop shop for people who love tech and want to diversify without having to pick individual winners and losers. What is our source like about this ETF?
They point out that SCG has low fees and has been performing really well, consistently beating both the S&P 500 and the Nasdaq 100. It's a simple and effective way to get in on the growth of the tech sector without having to actively manage a bunch of different stocks.
And what's their strategy for investing in SCG? Are they doing anything complicated with options here?
Nope. Their approach is pretty straightforward. Buy regularly, especially when the market dips, and hold on for the long haul. It's like the classic slow and steady wins the race idea, but applied to tech investing.
It's nice to hear something simple for a change after all those complex option strategies we've been talking about. But even with an ETF that tracks all these big, well-established tech companies, there are still risks, right?
Of course. Diversification helps reduce risk, but it doesn't eliminate it entirely. If the entire tech sector takes a hit, SCG will probably go down too.
So it's a reminder that no investment is completely foolproof. Understanding the bigger trends in the market is still important, even when you're investing in a diversified ETF like this.
Exactly. It's all about managing risk, not pretending it doesn't exist.
Okay, well, that covers the 6 investment targets from our sources portfolio. They're clearly not afraid of volatility, and they're using all sorts of strategies, some pretty complex, to navigate the market. It's fascinating stuff, but is it sustainable in the long run?
That's the big question. They've done well so far, but that doesn't guarantee future success. The market is always changing, and even the most sophisticated strategies need to adapt.
That's a really good point. It reminds us that investing is a constant learning process. Even experienced investors need to stay humble and adjust as the market changes.
It's interesting, isn't it, how they combine those high-growth, high-risk companies with something more stable, like the SCG ETF. It's almost like they're building a portfolio of strategies, not just companies.
Yeah, that's a great way to put it. It's like having different tools, right? Each one's good for a specific job. You wouldn't use a hammer to tighten a screw,
Yeah.
and you wouldn't approach, say, super volatile tech stock the same way you'd handle a blue chip dividend pair.
Exactly. And speaking of those volatile tech stocks, let's go back to Nvidia for a second. Remember how their stock dipped even though they beat their earnings estimates? That really shows you the power of, well, market psychology and how important it is to understand the difference between expectations and reality.
It's like the market's always trying to guess the future, and any little surprise, even a good one, can throw everything off.
Right. Sometimes doing well just isn't enough if it doesn't live up to all the hype that's already baked into the stock price.
It's a good reminder that investing isn't just about numbers and financials. It's also about psychology and how people are feeling. But how can regular investors who don't have access to all the same information as the big institutions make sense of all the noise and avoid getting caught up in the hype?
That's a really important question. It's so easy to get swept up in the fear and greed that drives those short-term market ups and downs. But if you want to succeed in the long run, you need a solid plan, you need to do your research, and you can't let your emotions make decisions for you, just based on headlines or rumors.
That's easier said than done, though, right? Especially when you see your portfolio going up and down and everyone has a different opinion on where the market's going.
It definitely takes discipline. But remember, this is a marathon, not a sprint. Stay focused on your long-term goals and don't get distracted by all the day-to-day noise.
Speaking of noise and distractions, let's get back to Palantir. Our source is completely convinced that this recent drop is a buying opportunity. But what are the risks of thinking that way? What if the market doesn't bounce back as quickly as they expect?
Well, their whole bullish outlook is based on Palantir continuing to grow and staying ahead in the AI market. But what if those government contracts, which make up a big part of their revenue, start to disappear? That could really hurt their growth.
And we can't forget about the ethical questions surrounding some of their work with the government. We won't get into the specifics here, but it's something some investors might think about when they're deciding whether to invest in the company.
Absolutely. Ethical considerations can be a big factor for investors, and it's important to align your investments with your values.
Okay, on a lighter note, let's talk about options trading. Our source seems to really like using options, both for making extra income and potentially boosting their gains. We heard about their wheeling strategy with Nvidia and selling puts with Robinhood. Those sound pretty advanced. Is that something the average investor should be doing?
Options trading can be a powerful tool, but it's definitely not for beginners. You need to really understand how options work, have a solid plan for managing risk, and be prepared to handle potential losses.
So it's not something to jump into without doing your research.
Right. It's kind of like learning to drive a race car. You wouldn't just hop in and hit the gas without knowing what you're doing, right?
Yeah.
You need the training and the safety precautions.
Great analogy. Now back to Tesla. Our source had some worries about their future, mentioning things like slowing demand, shrinking profit margins, and Elon Musk having his attention divided. Are their concerns valid?
I think their concerns are definitely worth considering. Tesla has had amazing growth, but the EV market is getting more crowded, and staying on top won't be easy.
It's like they've climbed Mount Everest, and now they have to figure out how to stay at the top while everyone else is trying to get there.
I like that. And having Elon Musk involved in so many different things adds another layer of complexity. He's incredibly visionary and ambitious, but investors are naturally going to wonder if his focus is spread too thin.
So is it time to sell Tesla stock, or are there still reasons to be optimistic about their long-term future?
That's a tough one. There are good arguments on both sides. It really depends on your own tolerance for risk and whether you think Tesla can overcome these challenges.
It's like trying to predict the weather. 6 months from now, there are too many unknowns to say for sure what will happen.
Exactly. There's a lot of uncertainty surrounding Tesla's future, and investors need to carefully weigh the risks and potential rewards.
Okay, let's talk about Marathon Digital again, the company tied to the unpredictable world of Bitcoin. Our source highlighted their strong financials, but they also admitted there's inherent risk in a company so connected to Bitcoin's ups and downs. How should investors approach a company like this?
It's a classic high-risk, high-reward situation. Marathon Digital could see huge gains if Bitcoin keeps going up, but they could also plummet if the crypto market crashes.
It's like riding a roller coaster in a hurricane.
Hmm.
You're in for a wild ride, but you have no idea which way it's going to go.
I love that image. It really highlights why you need a clear strategy, a deep understanding of crypto, and a strong stomach for volatility if you're thinking about investing in a company like Marathon Digital.
Now, what about Robinhood? They're trying to move beyond their image as a platform for beginners and become a global financial powerhouse. Our source is really optimistic about their chances, pointing to their impressive financials and their plans for expanding internationally. Is that optimism warranted?
Their recent numbers are definitely impressive, but the question is whether they can keep it up. Robinhood has a lot of competition both in the US and globally, and dealing with all the different regulations in other countries will be a challenge.
It's like they've built a rocket, but now they have to prove they can actually launch it without crashing and burning.
Yeah. Exactly. Robinhood's success depends on their ability to follow through on their plans, attract a wider range of investors, and figure out how to operate on a global scale.
And let's not forget about regulation. Robinhood's had its fair share of regulatory scrutiny in the past, and the financial industry is constantly changing its rules. How might that affect their future?
Regulation is a big deal for any financial company, and Robinhood's no exception. They need to be flexible and adaptable to stay ahead of the curve and make sure they're following all the rules.
It's like playing a game where the rules keep changing in the middle of it.
Exactly. Robinhood has to be strategic and proactive about regulation if they want to avoid making costly mistakes and keep investors confident.
Okay, let's shift gears to a more stable and diversified option. SCG, the ETF that tracks some of the biggest tech companies. Our source seems to prefer a simple buy and hold strategy for this one. What are the pros and cons of that approach?
The biggest plus is that it's simple and diversified. With SCG, you get exposure to a bunch of big, well-established tech companies with just one purchase. You don't have to spend hours researching individual stocks or worry about rebalancing your portfolio.
It's like having a personal chef who cooks you a perfectly balanced meal every day.
Exactly. But on the other hand, you don't have as much control. You can't choose which companies to invest in, and your returns are tied to how the entire tech sector performs.
So it's a trade-off between convenience and control.
Right. The best approach depends on your personal investment goals, how much risk you're comfortable with, and how long you plan to invest.
Let's talk about something that can make even experienced investors nervous. Market volatility. We saw it in action with a few of the companies we talked about, like Palantir's sudden drop and Nvidia's dip after their earnings report. How can investors stay calm and make good decisions when the market feels like a roller coaster?
Volatility is just part of the game in investing. It's something we all have to deal with. The
Hmm.
key is not to let fear or greed drive your decisions.
Easier said than done, right? Especially when you see your portfolio shrinking and everyone around you is freaking out.
It takes practice, but those short-term swings are often driven by emotions and speculation, not by real changes in the value of companies.
So it's about focusing on the long term, ignoring the noise, and sticking to your plan.
Exactly. And if you're feeling lost or unsure, it can help to talk to a financial advisor or a friend who understands the market. Sometimes getting an outside perspective can help you stay grounded and make better decisions.
Our source made a really important point that we haven't mentioned yet. Do your own research. Don't just follow someone else's advice blindly, even if they've been successful in the past.
That's such good advice. It's great to learn from others and consider different opinions, but ultimately, you need to make your own investment decisions based on your own research and understanding of the market.
It's like learning to cook. You can watch all the cooking shows you want, but you'll never become a great cook until you start experimenting in the kitchen yourself.
Perfect analogy. Investing is a skill you develop over time through practice, research, and continuous learning.
Now let's talk about something that often gets overlooked in investing: the mental and emotional side of money and decision making. We talked about avoiding emotional decisions, but how can investors become more aware of their own biases and tendencies that might be influencing their choices?
That's a really interesting area. There's a field called behavioral finance that looks at how our psychology affects our financial decisions. We all have biases and mental shortcuts that can lead us to make irrational choices, especially with money.
So it's not just about understanding the market, it's about understanding ourselves too.
Exactly. There are lots of resources out there like books, articles, podcasts that can teach you more about behavioral finance and how to recognize and manage your own biases.
It's like shining a light on our blind spots so we can make smarter decisions.
Yes, self-awareness is key in investing, just like in anything else.
Before we wrap up this part of our deep dive, I want to ask you and our listeners something.
Yeah.
We've talked about different investment strategies, research, diversification, risk management, but what about the bigger picture? How do you think the current economic and geopolitical situation will affect investment decisions in the future?
That's a big question. We're living in a time of a lot of uncertainty, right? We've got rising inflation, geopolitical tensions, constant technological disruption. All of that is going to have a huge impact on the markets, creating both risks and opportunities.
So it's not just about picking the right stocks, it's about understanding the forces that are shaping the world around us.
Absolutely. Investors need to be aware of the bigger context and how it could impact their decisions.
It's like trying to steer a ship through uncharted waters. You need to be aware of the currents, the winds, the potential storms.
Great analogy. And that's what makes investing both challenging and rewarding.
That's a perfect note to end on. We've covered a lot, but there's always more to explore. We've gone over a ton of stuff in this deep dive, breaking down specific companies and even getting into the psychology of investing. But like you said, there's always more to learn, especially when it comes to navigating this crazy market we're in.
Absolutely. And our source brought up a concept that we haven't touched on yet, this idea of a margin of safety, which I think
Oh,
is really important.
a margin of safety, huh? I like the sound of
Mhm.
that. What does it mean when we're talking about investing?
Basically, it means buying something at a price that's way lower than what you think it's actually worth. It's like having a buffer, just in case you were a little too optimistic about how much a company is worth.
So it's about being cautious with your valuations and not getting carried away by the hype, even if a company looks really promising.
Exactly. It's especially important when things are uncertain, or if you're looking at companies with complicated business models, or in industries that are known for being volatile.
I can see how that would make investors feel more comfortable, knowing they have that extra layer of protection. But how do you figure out a company's true value in the first place? Isn't that kind of subjective?
It's definitely not an exact science. You have to look at their financial statements, understand their competition, and try to predict how much money they're going to make in the future. There are different methods investors use, but it often comes down to making educated guesses based on the available information and your own judgment about the company's potential.
Sounds like a mix of analysis and gut feeling, huh?
You could say that. But even the smartest investors get it wrong sometimes. That's why having that margin of safety is so important. It gives you some wiggle room if your estimates are off.
Makes sense. We've talked a lot about the importance of thinking long-term in investing. But in a world where everyone wants things instantly and the market's always jumping around, how do investors resist the urge to react impulsively to things and stay focused on their goals?
It's tough, for sure. We're constantly bombarded with news and information that can make us emotional, and that can lead to impulsive decisions that might not be good for us in the long run. One way to combat that is to have a clear investment plan in place, something that lays out your goals, your risk tolerance, and your time horizon. Think of it like your roadmap for investing.
So having that roadmap helps you stay on track even when the market gets crazy.
Right, exactly. It's like having a compass to guide you through the fog. It's good to review and adjust your plan from time to time as things change, both in your life and in the market. But having that framework helps you avoid making rash decisions based on those short-term market swings.
So it's about being proactive, not reactive, and sticking to the plan as much as possible.
Exactly. And remember, investing is a marathon, not a sprint. Patience and discipline are key if you want to be successful over the long haul.
This deep dive has been so insightful. We've covered a lot of ground, from individual companies to the forces that drive the market. But before we wrap things up, I want to leave our listeners with one last question to think about. We've discussed ways to navigate this current market, but how do you think all these technological advances, especially in AI and machine learning, will change investing in the years to come?
That's a fantastic question, and it's something a lot of investors and experts are thinking about. AI and machine learning have the potential to completely change how we analyze data, find investment opportunities, and manage risk.
So it's not about humans versus machines. It's about finding ways for them to work together to make better decisions, right?
Right. AI can handle huge amounts of data, find patterns, and come up with insights that humans would never be able to see on their own. But humans are still essential for setting goals, understanding risk tolerance, and making those ethical and strategic decisions.
It's like having a superpowered research assistant who can help you sort through tons of information. But ultimately, you're the one calling the shots.
I like that analogy. It's about using the power of technology but keeping humans in control.
And that blend of human and artificial intelligence is going to have a huge impact on the future of investing. It's both exciting and a little bit intimidating.
I agree. We're in a period of major change and opportunity in the investment world, and the people who embrace innovation and adapt to these new developments will be the ones who succeed.
I think that's a great place to wrap things up. This deep dive has been fascinating, and I hope our listeners have learned a lot and maybe even have some new questions to think about.
We hope you'll keep exploring these ideas, do your own research, and have those thoughtful conversations about the future of investing.
And as always, remember that investing is a journey, not a destination. It's about constantly learning, adapting to change, and making smart choices that will help you reach your financial goals.
Happy investing, everyone.